Hey everyone, Joe from Avalon here. Today we're answering one of the most common questions we get from small business owners. What's the best way to pay yourself from your corporation? We'll look at two options, salary versus dividends, and discuss the pros and cons of each method. By the end, you'll know which method can save you the most tax. All that and nothing else coming right up. First up, let's talk about paying yourself a salary. Whether you call it wages, salary, or employment income, it's all the same thing here. If you've had a job before, you know how it works. You get a pay stub every couple of weeks showing your income and deductions like CPP, EI, and income tax. By the end of the year, you'll get a T4 slip to report your earnings on your personal tax return. So how does the salary actually work? The payments are an expense within the corporation, reducing its taxable income and corporate taxes paid. Your earnings are then considered employment income for which you'll receive a T4. This gives you a steady and predictable personal income. Here are some key advantages. Wages create RRSP contribution room. Paying yourself a salary builds RRSP contribution room, whereas dividends do not. There are fewer surprise tax bills. Income tax is withheld from each paycheck, so you avoid surprise tax bills when you file your return. CPP contributions, you can contribute to the Canada Pension Plan, providing future benefits. Good for mortgage applications. Banks prefer steady, predictable income when qualifying for a mortgage. Qualify for government subsidies and tax credits. Some programs require employment income to qualify. To pay yourself a salary, your corporation needs to register a payroll account with the CRA. You must withhold source deductions like CPP and income tax, remitting them regularly to the Receiver General. Late payments can result in stiff penalties, so have a system in place or someone to keep you accountable. Luckily, we've recorded a series of videos showing you exactly how to pay yourself a salary from your corporation. Check out the link in the description below. Next, let's look at paying yourself dividends. Dividends are a simple way to get money from your corporation to you personally. They're paid out of the company's after-tax earnings, not as an expense, so they don't reduce corporate taxable income or taxes owing. However, they come with a dividend tax credit, reducing personal tax liability. Here's why you might choose dividends. Remove CPP costs. No need to contribute to CPP, reducing costs. Simplicity, no need to register for payroll or remit source deductions. Just declare a dividend and transfer the cash. Fewer penalties, less chance of late payment penalties compared to payroll remittances. Less employer health tax. Some provinces tax wages, not dividends, so you might reduce health tax costs. In practice, paying dividends is pretty straightforward. Declare a dividend and transfer cash from the company to your personal account. You'll need to file a T5 once per year for any dividends paid. Here's a quick recap on taxes. Salary is deducted as an expense in the corporation and taxed as employment income personally. Dividends are paid from after-tax dollars and taxed at a lower personal rate due to the dividend tax credit. Tax legislators have set a goal for your total tax, corporate plus personal, to be the same whether you choose salary or dividends. This concept is called integration. However, sometimes one method is a little more tax efficient than the other. To keep this video concise, I won't get into comparing salary versus dividends for tax savings. However, you can find a link in the description below for a video where I show you how to compare tax costs across both methods. But keep in mind that your total tax paid from salary or dividends will often be very similar. This is why I like to emphasize that you should consider the whole picture when choosing salary and dividends. Think about RSP contribution room, surprise tax bills, CPP contributions, mortgage applications, and government subsidies. If this is all sounding a bit overwhelming, just give your accountant a call and they can help you make the right choice. All right, that does it for salary versus dividends in under 5 minutes. If you're looking for more ways to reduce your taxes, check out our featured video where I run down my top ways to save tax as a Canadian. And if you found this video helpful, please hit that like button. For more content like this, consider subscribing, of course. Lastly, if you have an incorporated Canadian business and are building your business to 1 million or 5 million in revenue and are interested in our services, head on over to our website to schedule a meeting. We'd love to hear from you. Thanks for watching, and we'll see you in the next video. Cheers.